Prateek Agrawal joins us. Let's take our conversation forward and let's understand that what he makes of the current market setup. Prateek, good morning. Good to have you back. We've seen a good comeback by the bulls. Markets almost at a new high. What, to your mind, is fueling the rally?
So the India story continues to be very consistent. There has been a slowdown in some small pockets like QSR, but by and large, it continues to be consistent. Now, in that makeup, when of the two large blocks of investors, FPI sell, domestic secular buy, we get a flat to a negative market. When the selling pressure reduces, you get a +1, +2% a month kind of market. And when both starts to buy, you get a 7% a month kind of a market. So it is basically that, we are at fair valuations. What you are looking at is earnings kind of compounding going forward, which if you split on a monthly basis is a percent kind of compounding a month. And hence you will see, or you should hope to see, long periods of sideways to down moves and then a spurt when both the big blocks of buyers or market participants act in the same direction.
Where does the valuation picture come in now? Because nobody said that India was a poor story in 2022 also. Everyone said that India is a great market, but if you're buying silver at the price of gold, you ain't going to make money. So where is that logic now? I mean, the story, the appeal, the earnings is still there, but after the run-up, valuations are again rich.
So since you use the silver and gold analogy, well, there is gold and there is fool's gold. As of now, we do look like gold, on the lighter side. My construct of valuations in the marketplace is 18 to 18 and a half times 1 year forward earnings, something that I have been saying for a long time now. And if next year earnings are going to be between 950 and 1000, mood swings keep changing that number. The present construct is good. We have moved 1.5 months into the new year. You take 3 to 4% kind of compounding a quarter. So, half of that is over 1.5% into the new year. So very much sustainable levels to my mind. If you look at last 12, 13 years of the market, we are at average levels. Now, if you compare the two large asset classes, debt and equity, earlier, we were saying debt is relatively more attractive. Yields themselves were higher than equity yields. However, now debt yields have fallen, and now even on pre-tax, equity is very competitive. Post-tax, after April, for Indian investors, equity is super competitive versus debt. So that is the thought on valuations. If you are an domestic investor, I think, and long-term, then equities is the place to be in, to my mind.
Why do you like new tech? I mean, nobody likes new tech. They are not making money. There is an anchor selling which is there. There are Chinese investors which keep on selling. Why do you like new tech? You're smiling a lot today. Were you smiling a lot? Am I asking you the rash questions? Am I asking easy questions?
You like new tech.
No. You're smiling a lot today. In over the years I've seen you, I've never seen you smile that much. So I'm not complaining. But I'm asking easy questions.
I was more because you were tingling me on that side. So I said, okay, let's have some fun.
Okay, new tech now.
So we have been saying, while market participants may not like new tech, the kids like. Okay, and kids are the future. Look at it this way, on a lighter side. Second, we have been saying these are great businesses, good valuations, but ownership changes will cause volatility. We have been saying this for past few months. Today, if you see across our house, we have a sprinkling of one of the two or maybe three new tech names across our funds. We do believe we are quality and growth investors. Today, on valuations, frankly, 100% of the street has put significant upside to all of these names. Liquidity is good. Growth will continue to be there for a very long time. So for a quality and growth investor like ourselves, these are spaces to be focused on. After the fall, valuations became good, and that is the reason we have got a sprinkling of them across our funds. Not very high number, but a sprinkling everywhere.
Right. Similarly, Prateek, in this market, what would you believe are the spaces to avoid? For a while now, it's been IT, but do you think even IT is reaching the zone where you would want to nibble in?
No, so there is a construct that we have. Okay, so as a house, we are underweight IT, but it is a large part of the index, and there is a risk budget that every manager has. So on the mutual fund side, we have said 7.5% max deviation to the index. On the alternate side, it is a tad larger, but it still means the managers have to have some amount of IT in the portfolio. What we have by choice is mid cap IT versus large cap IT. So it's not that we don't have the large names, but lower. Our thoughts are that mid cap IT, especially in the tech space, especially focused on verticals which are not seeing a slowdown. So autos, technology changes, airlines, hotels, those are spaces where business momentum is strong. Maybe even telecom, where 4G to 5G is going to be a big spend. Our spaces, whichever company is strong in this space is where we are glued at.
It was interesting that we were discussing just a couple of days ago, Prateek, that Zara India performed very well, and that the retail pie clearly seems to be holding out with the kind of consumer spending behavior patterns. What's your outlook on the entire premium retail and even the entire retail space?
No, so very focused on premium retail. So this is a year where we are going to see a slowdown from a 15% nominal growth that we experienced in financial 23 to a 10.5% growth if we go by budget assumptions. When there is a slowdown, both on account of inflation and on account of real growth, one segment that will hold out much better is premium retailing, and we are in our choice of discretionary consumption more focused on premium retailing. And yes, there are particular segments. So this is a new format, fast fashion. Whosoever is doing it is doing a good job of it. People have understood that this is a category that sells fast. So that is the other thing that we have in the portfolios.
Okay. What is slow and boring? Because you like new tech companies, you like fast fashion. So you don't like the old boring things, NTPC, Power Grid, REC, all that is not on your radar?
So now it has been 12 years that they have not been on our radar. So quality is there in many of them. Valuation comfort is there in all of them. But growth, the quantum that we want is not there in any of them. Is the reason why we are not there. But that said, there is a name or two in the renewable power space that we are invested in. One of the smaller funds does have that name, but we really want to stick to QGLP and try and see how each name takes each one of those 4 letters.
All right, Prateek, thank you for joining us. By the way, I forgot to ask you one simple question. There is a newspaper article which I read that AI is making life difficult for fund managers now. First, they had to trouble to beat the benchmark, and now they have to beat AI also. Is it true?
What is AI?
AI,
Artificial
of
intelligence.
Course. They will make us redundant. I'm scared of my job.
So just imagine, I mean, first it was beating the benchmark. पहले निफ्टी इशू होता था, AI भी आ गया.
Good.
Two things you have to beat.
In AI compete with each other and we have a life.
Well, what a world we live in, man. I mean, what a world we live in. Appreciate your time. So glad you could join us. Bye.